very warm welcome, everyone. My name is Nicholas Tan from Kenanga Futures Sdn Bhd. Thank you for spending your precious time to join our webinar today. It's a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivatives to the participants. Please take note that futures and options trading involves substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes. Kenanga Futures Sdn Bhd accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. So before we start, we would like to take this opportunity to invite you to the Kenanga Futures next webinar, which is on 28 July this month. It's about the strategies of trading FCPO, futures crude palm oil. Right? An invitation email will be sent to you. And don't miss out. Please remember to register once you receive the email. Next, if you have any questions for our speaker today, please feel free to post your question through the Q&A box on the right side of or on the bottom of your screen, and he will attend to your questions after the presentation. So today we have Mr. Edwin here, and he's going to share with us on the topic on let's learn about futures. So without further delay, I would like to kickstart our webinar by welcoming our speaker today, Mr. Edwin.
Good evening, ladies and gentlemen. First of all, thank you, Nicholas, for the introduction. I would also like to take this opportunity to thank all our guests or listeners joining us today. Thanks for sparing your precious time to join us for this talk on the introduction to futures. Okay, basically the agendas and topics that I will be covering today is basically an introduction to derivatives. Derivatives is basically futures falls under the derivatives grouping, and I will talk a bit on the regulatory bodies, means the governing bodies, the regulators that oversees derivatives and futures trading. Introductions to futures. What is the futures contracts? CME futures products, some basic trading strategies, risk management strategies, and of course, how do you start trading futures. Basically, this is the agenda which I will be covering today. As we progress, I think I probably have 50 over slides, so I will try to make it as concise and informative as possible for all our listeners in today. Okay, to start off, basically, what are derivatives? I think this is a very commonly asked question by a lot of our new clients, and generally this topic which we are covering today are basically focused towards those people that have interest in trading futures or have somewhat some basic knowledge in futures trading. So basically, futures is actually it's a financial instrument that allows people to manage their portfolios in volatile markets. It's the futures, the derivatives is actually derived from an underlying instrument. So when I say underlying instrument, it's basically in terms of, I'll give you an example, just say for gold commodities, all right? So the underlying instrument or the underlying asset is actually the physical gold itself. So when you trade in derivatives, you are basically trading in the expected value, the future price movement, the fluctuations of that product, the asset, the underlying asset in a future point of time. Okay, derivatives is basically widely used for hedging, speculating, and arbitraging. But for the purpose of this presentation today, I will be basically focusing more on the speculating aspect of trading futures. Okay, and the products which we are covering today are basically what we would consider listed derivatives. Means they are basically all regulated by the exchange. So moving forward, this is an example. In the US, it's basically the regulatory body that monitors futures or derivatives is the CFTC. So it's basically the Securities Exchange Commission, SEC. These are all the various regulators that monitor and basically has an oversight of futures in America. The Malaysian equivalent obviously will be our Securities Commission. They are a local regulatory body, and basically the function, why I'm highlighting this is this particular slide to you is to illustrate that futures products that is being offered by Kenanga. basically all regulated products under these exchanges. Okay, moving forward, this is the exchange itself. So just now, as I said, was previously the regulatory bodies, which actually is the oversight that oversees these exchanges. So the prominent exchange in the US would be the CME, or Chicago Mercantile Exchange. So they are basically the world's leading the exchange for these futures and derivatives. They have offered basically a vast product across all asset classes, whether it's interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. Basically, it's traded on this what we call a CME Globex platform, which is more or less almost 24 hours trading. The actual timing I will be sharing with you in a further slide. And it also provides clearing and settlement services for all the products which is trade. They also actually offer OTC products, means over-the-counters products, which goes through their clearing house, which is different. The ones which we are covering today are exchange-traded futures. Okay? So under the CME itself, there's 4 exchanges, which is the CME, CBOT, NYMEX, and COMEX. Basically, it was the merger of these 4 different exchanges that now basically fall under this CME grouping. So in Malaysia, our equivalent will be our BMD, Bursa Malaysia Derivatives, which is essentially under Bursa Malaysia itself, which is the holding company. Next, moving on. I will do a brief introduction about futures. Now, what is futures exactly? Okay, futures is actually a pricing mechanism which is derived from an underlying asset, which I've mentioned earlier. The underlying asset is basically, it can be commodities, it can be index futures. And what you are doing when you are trading futures is you are actually anticipating the price movement of this particular asset at a certain point in time in the future. Okay, so okay, it's basically a standardized format which we have this thing called a contract specification. Okay, so every different product has its own contract specification. And I will give you examples of these contract specifications as we move on further through the slides. Okay, so the futures was actually initially introduced as a form of hedging for basically people who have physical exposure in the market. For example, it started off with commodities basically, whether it's like gold or crude oil. There was a need for them to actually, when I say hedge, it's actually basically a mechanism to protect their investments based on fluctuations of the pricing in the future. Okay. Now, next on. Okay, who uses futures? Okay, basically these are on the broader spectrum. There are three types of people that would actually trade futures. Okay. Hedgers, as I was mentioning earlier, are basically people that are actually involved in the physical aspect of the products. For example, if you look into agriculture, people that are the farmers, like in Malaysia, we have the crude palm oil. So these will be like the people like in the plantations, upstream and downstream. As long as they're involved in the industry, they would be susceptible to any price fluctuations. So they actually use futures as a mechanism to manage their risk. Similarly to financial institutions, we have banks in terms of like interest rates, and also to a certain extent currency futures. They use it as a form of risk mitigation. And the next we have speculators, which I think most of us would actually fall under. So basically investors looking for an opportunity in terms of the price fluctuations to make profit, to see it as a trading tool for them to earn some profits. Okay, so basically futures is a tool where you can actually do buying and selling, which we call the the technical term is long and short. So it allows you to move in both directions. And this will be elaborated further down during my presentation. And obviously, the third aspect is orbitals. Basically, this is actually more for those institutions and trading houses, which what they do is, because there are various markets and similar asset underlying assets, for example, crude oil and for example, crude palm oil and soybean oil. So if there's any discrepancies in the prices between these two products, inter-products and inter-exchange, they will actually basically lock in what they call, the term which they use is arbitraging, to lock in these profits in terms of the discrepancies in prices. But this is a more sophisticated form of trading, which I think it's not so applicable for this introductory presentation on futures. Now, what are the advantages of trading futures? Now, I think one of the key advantages, which actually it allows you to leverage. Okay, I think as with in all investments, investors want to put in the least capital to make the highest return. So in terms of trading futures, you put in a margin, which is basically a percentage of the underlying asset to trade in that particular futures product. Okay. Secondly, the futures market is very liquid. If you have large positions, whether it be in like crude oil or Dow Jones futures, it's very easy to enter and exit the market, because they are both sides on the bid and ask. They are very large sizes, which can easily accommodate your orders, so to speak. Commission and execution costs are low. Okay, in terms of futures, basically there is a flat monetary amount. Okay, most equities is in percentage, but futures is regardless. If you trade one contract, or as we commonly call it, one lot, basically you just pay a flat monetary amount. Okay, and speculators can make faster money. Okay, just as a disclaimer, you can earn fast, but also you must be able to manage your risk well, because in the situation where you are not on the top of your game, there's also risk exposure. I mean, in terms of your P&L. Okay, so generally the futures market always tend to move faster than the cash or spot markets. This is the case because you are actually trading in anticipation of the market. So you are more or less based on your analysis, whether it's on fundamentals or it's on technicals, you're actually anticipating where the market is going to go. Okay, and futures is a good way to diversify your portfolio. I think many people have positions in the equity markets and to a certain extent some currency investments, but derivatives and futures in general, it's a very good way for you to basically just diversify your portfolio. Okay, so this is just moving on. This is just a brief comparison. It's between the differences between futures and equities. Okay, so when you trade in futures, basically you are buying or selling something based on an agreed price, future agreed price of the asset class. Whereas when you buy share, you are effectively your equities, you're actually buying a share in the company. That means to a certain extent, the ownership of the corporation. Now, margin, I will elaborate more on this topic of margin later, but generally, you require about 15 to 20% of the actual value of the underlying asset, which is a fraction. It depends on the asset that you are trading, the futures product which you are trading. For this one, for equities, basically now, so depends on which broker the securities you are trading to. Some, 50% upfront, and then basically this assuming that you are doing a share margin. That's why I said that the balance 50% will be from the loan from the broker or the securities. But essentially, you have to pay 100% upfront. Okay. One of the other features about futures is it allows you to selling short. Okay, so basically you can sell first and buy later. And for equities, I think especially in Malaysia, this feature is, I would say, restricted. And as I'm sure many of you are aware that these restrictions have further been tightened during the recent pandemic outbreak. So now basically there's a short selling is in a way not very restricted on the equity side. Okay. For timing futures, basically we are trading in contracts months. Okay, so there is an expiry date. Generally, if for indices you are looking at the spot month of expiry, means you have essentially about 1 month. But for commodities, we usually trade for 3 months forward. So it will be 3 months forward will be what we consider the active month. Okay. In terms of your risk, in terms of losses, okay, one thing which we would like to highlight is that there is a possibility when you trade futures, if you are not managing your risk well, there's a potential that you might actually have an overloss. So overloss is a term which is basically when your margin goes to negative. Okay. For equities, basically it's the share value. Basically, you can hold it up until basically if it goes to $0 valuation. So this slide is basically just to highlight some of the differences between the futures and the equity markets. Okay. Now, moving on, just to further elaborate on the further slide, leveraging, as I mentioned, means you want to put in the minimum amount of capital to get the maximum amount of return. Okay. So basically, small movements in the market, right? Futures, it can actually translate because of this so-called this leveraging benefit. It can somewhat inflate your P&L. So this is something that it is a double-edged sword, no doubt. But you can you manage your risk wisely. You can use it to your advantage. And as previously mentioned, diversification, now I think it's wise nowadays basically to hold a lot of different asset classes just to have a more wider and broader scope of your portfolio. And as previously mentioned, transaction cost is a fraction of what you would actually pay in if you are trading equities. Okay. Now, for the illustration, two-way entry, as I said, long short, you can buy, sell. I think this allows a lot of people to actually capitalize on the downtrend, especially in Malaysia. During the recent pandemic, I would say there was a huge interest in futures trading because I think a lot of people were, I would say, bearish in the markets. And because of the limited availability of the equity size to short the market, a lot of people actually traded open account and traded futures because it allows you to capitalize on down markets, downtrend markets, so to speak. Okay, and protection and speculation, I think mostly these are for mostly for institutional and corporate clients. They use it, I said, as for protection, it's a way to manage their risk because they are holding the physical product. Speculation is basically for the retail market, the everyday traders like in the markets that treat it as an investment, so to speak. Okay, standardization is the contract specifications, which I was mentioning earlier. This would actually is a standardized format, so it has a contract specification. Everything is stated down in black and white. So I think it's in the sense there's a lot of transparency, because everyone is held to that, basically to that contract, to that standard. Okay. Now I would like to talk a bit more about this. This is the exchange, CME, Chicago Mercantile Exchange products. Okay. So as you can see, they have a very extensive list of products, which covers equity derivatives, precious metals, financial derivatives, energy, and also agricultural commodity derivatives. So it's a very wide spectrum. So it's not just limited to certain products, and this is just rough the summary of the products they are trading. If you actually go through in detail, there is actually the list is very, very extensive. Okay, so these are the commonly traded products on the equity derivatives. And now I would actually like to focus more on one specific product to the indices to give you a better example, just to illustrate how you can trade a futures product. Okay, so I think most of us here are familiar with Dow Jones. Okay, US market, everybody knows the Dow Jones. So effectively, when you trade Dow Jones futures, what does it mean? Okay, So Dow Jones Futures, where it basically now tracks the 30 largest companies in leading sectors in the US economy. Okay, so every there's a calculation and there's a breakdown of the weightage of each of these companies which contribute to the Dow, right? So essentially, when you are trading in index futures, right, you are buying a bucket of shares with inverted commas. Indirectly, you are buying a bucket of shares. So instead of looking at one particular counter, you are looking at a broader scope. The top, I would say, the top companies within that the exchange. Okay, so for this particular product, is basically traded 24 hours a day. Okay, there's a short intermission, and I will give you the breakdown, the timing later when I go through the contract specifications. And it's basically is a market that basically is affected by global trends and major moves across the globe, so to speak. So it's a very buoyant and it's a very exciting market to trade. And okay, next, this is the thing that I was talking about. So okay, now we move on to the contract specifications. Okay, so as the underlying asset itself is the what we call the cash market, okay, so to speak, the Dow Jones Industrial Average. This is what is the underlying asset. Now, the contract size means if we are looking at the ticks, right, it's equivalent to $5 US. Okay, so based on the this minimum price fluctuation, 1 point is $5. Okay. Is traded on calendar months of March, June, September, and December. These are the quarterly months, but it's generally traded on the spot month. Means generally, like for example, now July, it will be July and the forward month, which is August, and then we have basically it spreads down all the way until the active months can go up to I would say the quarterly month of September. Okay, so unlike equities, when you trade futures, you are trading based on the month of that particular futures, which expires at the end of the month. Okay, and what happens? A lot of people ask it at the okay. For example, just say I'm buying July futures. What happens at the end of July? Okay, so basically, it's for in this Dow Jones futures, it's cash settled. So whatever the settlement price, which is calculated back to the underlying asset, there's a calculation, there's a formula. You will take a realized P&L, either a profit or loss based at that price when it expires on the last trading day. For example, this month it will be the last trading day of July. Okay, so that is how it works. But settlement type is different for different products. But specifically for this Dow Jones futures, it is cash settled. Okay, so the final trading day, it will be all these are basically the day when the contract is actually valid, so to speak. Okay, position limits, obviously I think this thing is every product has a certain limit, and I think it's basically it's a very large limit. So as I think primarily this talk is for retailers, we do not have to delve into that area because it's in tens of thousands. Okay, now trading hours, this one is quite important because as I mentioned previously, it's essentially trading 24 hours. Okay, so it starts at 6 in the morning. This is just refer back to Malaysian time. Okay, so 6 in the morning until 4:15 a.m. Then there's a short intermission break of 4:30, from 4:15 to 4:30. Sorry, then it trades on until 5 o'clock. So as I can see, if you are someone that is up late at night, then this is the perfect product for you to actually look into. Okay, so as I spoken earlier, top 30 counters. So when you are buying the index futures, you are buying all these counters, so to speak, with inverted commas. Okay, factors that move the Dow Jones. Obviously, there's a lot of things that will actually move the Dow Jones futures or the index itself. Okay, things that we look into, and especially when we when we share our opinions with our end clients, is we digest a lot of information. So obviously, when you're dealing with a US product, the things will be like the economic data, US economic data, their GDP, inflation, and we are always looking at their jobless claims, their corporate earnings, and then of course the FOMC, their federal market open market committee meetings, and also fiscal policy, monetary policy, their currency. So generally, all these are the factors that we look into. This is more in terms of fundamental. Obviously, we also do look at technical. We do technical analysis. We read into the charts and everything. And generally, that's how you would actually form a view whether to long or short the market. Okay? This is just, I will skip through this, but basically these are all the data that we actually also compile, and we actually share this with our end clients, just for those that might actually need it actually. Okay, so just now it was covered the equity derivatives. Now we are moving on to these are some of the examples of more into commodity derivatives. So as you can see, I would say they have a lot of also commodities that are being traded. This particular segment is just on energy derivatives. So the most commonly traded product on this under this asset class would be crude oil. Crude oil is very popular, and the technical name for it is WTI, West Texas Intermediate crude oil futures. So basically, it offers an opportunity. Mostly, a lot of petroleum companies trade this product, more so for hedging. And because of the liquidity, a lot of retailers would also trade this product. I think recently there's been a lot of excitement, whether for better or for worse, in terms of the price fluctuations. Especially during the pandemic, the prices were very, very volatile. Opportunity and risk was one of the scenarios that were in play during this the pandemic. Now moving on to the contract specification. So just now I gave you an example of a index futures. Now I would like to share with you one on commodities. So similarly, the underlying asset is the crude oil, WTI crude oil. It's traded, the contract size is 1,000 barrels. Okay, so it's the fluctuation is basically 1 cent. So it's basically 10 US dollars per contracts. It's traded all months. It's really, it can span on to 2 years plus, because as I said, it's an instrument for a lot of these people that are involved in the oil and gas industry to hedge. Okay, limits as well, all this, the timing is similar, the trading hours is similar to the previous. Basically, there's a 15-minute break in between 4:15 to 4:30 and closes at 5. So I will not delve too much in the contract specifications. These are something I will be sharing the slides later, so all of you can have your time and have a look at it. And okay, so this is basically the definition of what is this crude oil. I think this is something that you can probably read through on your own time, because I think due to limited the time constraints, I will try to speed up on what I think is not so necessary and focus on the key points. So these are basically all information and data. So if you do have an interest in trading crude oil, this kind of information would basically help you, and it will be made available to you by our dealing team. Okay, so once again, factors moving crude oil, we are looking basically when you talk about commodities, right? It's all basically based on demand and supply. Okay, so these will be the key fundamentals, the so-called price movers when you are trading in commodities. Okay, moving on this. Okay, now is to move to the more interesting part, I would say, basic trading strategy, because I think most of you will want to know, okay, now you understand what future roughly is, or you have a better idea. How do you actually trade futures? Okay, so this is an example I will use based on the E-mini Dow, okay, which I mentioned earlier. So you can basically long or short. It depends on your view, your analysis of the markets, your reading, whether it's on fundamentals or technicals or even both. Okay, so based on that, you will make an informed decision whether you want to long or short the market. So if the market is bullish, you would want to long it. All right. So if you're looking, these are just hypothetical values. In terms of the pricing, now assuming that the Dow is 26,200 index points, okay? So you expect it to rise, what you do? Obviously, you would buy, okay, you long, okay? So in theory, it goes up to 26,550, right? So the difference between 26,200 and 26,550 is basically 350 points. So when it hits the 26,550, which I assume so it's your step 2 right here, right? You actually just sell it, all right? You go to the market, you just liquidate it at that price of 26,650. So what happens is you have incurred, you have made a profit actually of $1,750. So it's based on that remember I told you $5 per tick per index points multiplied by 350 points which are made. So this is a very example on the long side. Similarly, I do want to focus a bit on the short side because I think some of our listeners might be new to this shorting. Okay, so what happens if you see the market, you are bearish, you think the market is going to drop. So what happens is you short the market, you short sell at 26,200 okay, and assuming it drops to 25,850. Okay, so market drop is in your favor, okay. So when you look at step 2, what you do now is you buy back the market. So you short sell first, now you buy back, okay, at 25,850. So essentially, you also make 1,750, being $5 multiplied by the 350 points which you have made on the downside. So this basically illustrates the one of the key features of futures, which allows you to buy, long, or short sell. That's it. Okay, pretty straightforward. And similarly, this is also, I will not run through it. I think it's basically the same the process as the Dow Jones. You can long, if you are bullish market, you buy put oil, the price goes up, you make just multiply by the tick size. In which case would be 150 times the 0.01 cents which I told you about earlier. So you would multiply by 10, so you would make 1,005. On the bearish side, if you sell, market drop from $37 to 35.50, you make 150. You multiply by the tick size and the value, you get 1,500 US dollars. Okay, so this is how you would generally trade. This is a very bread and butter illustration just for you to get a gist of how futures work, especially on the short selling end. Okay, now one very important aspect of futures which I have to touch on is actually understanding margin. Okay, what is margin when you trade futures? Okay, so basically margin is initial deposit where in good faith when you put in with your broker that allows you to trade these futures. It's an initial for you to go into the to hold and take up a position at that particular of that particular futures. Okay. Maintenance margin obviously is what you must maintain minimum the margin requirement per contract or per lot if you like in your account to hold that position. Okay. When does a margin call happen? Okay, a margin call happens when that the amount of the margin that you have with us falls below the required maintenance margin. So when that happens, we will generally you have to top up, so to speak, top up margin. Okay, usually it's T+1. The process flow is that we will contact you, our dealers will contact you, and the dealers will contact you and they will inform you of the margin call. So basically, you just have to top up whatever difference in margin there is for your account. Okay, so margin requirement. Okay, how does this margin work and based on what calculation? Okay, so it varies from exchanges to exchanges and also from product to product. Okay, so but it's typically around 2 to 20% of the contract value. When I say contract value, I mean the underlying asset. Okay, so this is they have a calculations for it, the exchange, and all these margins are published. Okay, on it's very accessible. You can go onto their websites. Even your brokers also will have a margin list. Like for us, for our foreign futures, we call it our overseas product. We send out a margin requirement email every day so that everybody knows that's what is required for them to what margin is required for them to hold in their account. But having said that, this margin doesn't exactly fluctuate all the time. Okay, so there are variable factors that actually have to come into play before there is what we call a margin change. Okay, so a typical scenario is, okay, over a long weekend, okay, just say, of say public holidays, they might revise the margin, they might increase it, okay, because overseas exposures, you don't know what's going to happen during that time period. They might increase it, but this is not this is just one of the example, one of the variables. When the exchanges calculate what is the margin required, what margin they want to set, is based on a variable, multiple factors, okay. So it's a lot of factors. One is also volatility, whether the market is very volatile, they might increase it and whatnot. Okay. So moving on, now we move on to this FM, forced liquidation margin. Okay. Now, generally brokers reserve the right. Okay, but this is I would say not a broker to broker basis, because every broker somewhat has their own risk management in place. But this illustration is just a general example. So if you fall below 20% of the required the margin, just say example, you need say $5,000 US, but now you have less than 1,000, so less than 20%. They have the right, if it's in their terms and condition, the account opening when you open, to actually force sell your position now. Okay, so this is something that you might want to take note when you are managing your margin. Okay. Moving on, okay, okay, this one is just example of a margin call. Okay, this I'll quickly go through it, but it is very relevant. Okay, the example here I'm going to use that is Dow Jones, same 26,200 points, assuming that on the day one you do not make any profit, the market does not fluctuate, it closed exactly back at 26,200. Your initial margin, the margin you should put in is 12,000, so no margin call. Okay. On the day two, now we move on to trading day two. Okay, the contract goes higher by 300. You long, right? So when you long, you make profit. Okay, so when it goes up by 300, it's now 26,500. So based on mark to market at the close, you are making 1,500 US dollars. Right? So now your equity, your 12,000 has increased by 1,500. So now you're holding an equity of 13,500. Right? Unfortunately, on day three, just say market, it drops 330 points. Okay, so back to 26,170. So this is already it's in the red, so to speak. Okay, so your 13,500 has now been deducted mark to market 1,650 here. So your equity in your account is 11,850. Okay, so based on this scenario, initial margin you see right on top here, you require 12,000, right? But now your equity, you only have 11,850. So what happens is you have margin for 150. So you need to top up your margin to go back to 12,000 to be out of the margin call. So the following day, T+1, you top up 150, then no issue. Okay. But then assuming on the fourth day, it goes back up to 26,650, then it's in your favor. So you make back the 2,400 plus the 150 which you deposited. So this is in essence how margin call would work. Okay, so this is a summary for you to look into. As I said, do not worry, the slides will be shared with you, and as always, you can always reach out to us after this presentation to get more information. We are more than happy to share this information with you. Okay, risk management strategies. All right. So basically, when you trade futures or any product, you have to have risk management. The truth about it is, when a lot of people trade, I can tell you frankly, a lot of people tell me that trade futures sure lose money. Yeah, but it all boils down to risk management. If you have good risk management and you are disciplined in terms of your cut loss and whatnot, you have a good trading strategy, then actually it's a very interesting product to trade in, because as previously I mentioned, there's like the benefits of it in terms of leveraging and whatnot. So these are just some of the key takeaways I would like to share. Everybody knows the rule when you need to cut loss, have a stop loss, but whether or not you can execute it or not is a different story. So on our end, what we usually recommend to our clients, just key it. As soon as you place an order in market, we always encourage our clients to actually key in a stop loss as well. So at least their downside is limited. So the following points are basically, stop loss, take profit points. You must know when to take profit. It's always the sad point is people always take profit too fast and let their stop rise. It's always the reality is as such. To be frank with you, you're supposed to let profits run and cut short, but it's always you cut your profits and let your you cut your profits and you let the losses run. So in that sense, you need to be able to manage this well. And finally, as I said, don't put your eggs in all one basket. You need to diversify and hedge. Trading one asset class or trading one product is in this day and age not very advisable. Okay. So now that we have covered the broad spectrum, a very broad stroke of what futures is, this is just, I think this part I have to just talk a bit about ourselves. Basically, we have been in the industry for a very long time. Interestingly, we do offer products across 3 exchanges, Bursa Malaysia, BMD, and of course Chicago Mercantile Exchange, and also this Hong Kong Exchange. So these are if you require further information or the list of products, we are more than happy to share it with you. So it covers a broad spectrum of products which we do. Okay, the list is quite extensive. So moving on, this, as I said, all I've already spoken previously. All these are the different futures products which we offer. Okay. Then moving on, these are the BMD products we do for Malaysia. Palm oil is crude palm oil is very popular, and also our local index. And okay, so basically, if you want to trade, open an account with us, you can basically contact our team. I think okay, before I move on to the sector, these are the kind of the services I would say that we offer. We offer daily commentary. So every day we will send you, like for this is just a sample. You can see all these FTLI is our local index, crude palm oil, UX, Hong Kong energy. So we actually send out these reports to you every morning. Okay, so some information, commentary, okay, we share with our daily commentary, which we share with all our clients, and also market updates and reports. So this is more on a macro term, like we do it every quarterly or every biannually. We give you all these reports. Okay, in terms of trading, we are very trading friendly, so to speak, electronically wise. You can use, we have the apps. You can, our name of our platform is trading platform is KDF Trade Active. So you can either go through your app base, or you can download the software and trade from your laptop, PC, and whatnot. Okay, so this is all basically the account opening process. This is a sample of we have it on App Store and also on Android for the trading the smartphone app.
Edwin, is there anything else you would like to add on before we end the session?
I just hope that you find this brief presentation webinar informative, and as I mentioned earlier, please do reach out to us if you have any queries. We are always more than happy to assist. And thank you for your time.
Right, great. Thank you, everyone. Should you have any further queries, please feel free to drop us an email at bcrm@kenanga.com.my. We appreciate you being here and hope that you enjoyed the webinar today. Please take a minute to rate our webinar, and your feedback is highly appreciated. Again, don't forget to register for our next webinar. And thanks again for joining us, and hope to see you again in our next event. Stay safe, everyone, and good night.
Okay, thank you all. Thanks, Nicholas. Bye.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.